Hello everyone, welcome to Safe Stock Investment. In this video, we are going to explain the basic concept of earning per share ratio and how it is used by analysts to recommend investments in stock market. The earning per share ratio is very important ratio which is considered by analysts as an indicator of the overall financial performance of the company, earning capacity of the company, and the operational performance of the company. The earning per share ratio is basically reflects the amount of profit ultimately available for equity shareholders. This ratio is calculated per share, per equity share, and it is shown in rupees. For example, I have shown two companies' earning per share ratio. Tata Consumer Products face value is 1 and earning per share ratio during March 2025 is 13 rupees and it was 12.32 in 2024 and 13 again in 2023, 10.15 in March 2022 and 9.30 in March 2021. Similarly, you can see the earning per share ratio of Bharti Airtel Limited. The face value of the company is 5. So it started from a negative of 27.65 in 2021 and ended 58 rupees per share during March 2025. So basically, the amount of earning per share ratio shows the ultimate profit available for each and every equity share. So if your earning per share ratios improve, it means the overall financial performance, fundamental performance, and operational performance is increasing. Therefore, it indicates the overall growth in stability and future prospects available for equity shareholders. So normally, when come to the investments based on the financial fundamentals of the company, most of the equity investors look into earning per share of the company. It becomes very important to find out why earning per share ratio is very important for equity investors. EPS is very important for equity investors because it helps them in measuring companies' profitability. As already explained, the amount of earning per share shows the profit available for each and every equity share. So ultimately, the overall profitability of the company is measured in terms of earning per share. Calculation of PE ratio is also very important for equity investors for making investment decision. The calculation of price earning ratio, that is PE ratio, is based on earning per share ratio because the formula PE ratio is current market price divided by earning per share. So without calculating earning per share ratio, you cannot proceed further for calculating price earning ratio. Comparison of companies is very important to find out the best company for making investments. So the financial performance of companies are compared based on various accounting ratios. One important ratio is earning per share ratio. If EPS of one company is higher than the other company, it is better you select company with high earning per share ratio. Identifying the growth trends. Normally, if you want to analyze the growth trends of the company, you have to calculate the earning per share for various periods and compare whether EPS is increasing or decreasing. If EPS is increasing over periods of time, for example, quarterly results shows the earning per share ratio is consistently increasing. It means the overall operational financial performance of the company, overall efficiency of the company improves. Similarly, to find out the amount of dividend payable to equity shareholders, that is to estimate dividend potentials of the company, EPS is very important one because based on EPS only dividend is declared. It means a part of earning per share ratio is distributed as dividend to equity shareholders. For example, earning per share ratio of a company is rupees 5. Out of 5 rupees earnings available for equity shareholder, a part, maybe 3 or maybe 4 or maybe 2.5 will be distributed to the equity shareholders as dividend. Similarly, to predict the stock price movements, EPS is also used as important tool. If earning per share ratio is consistently increasing, it means stock price will increase because the fundamentals is increasing. If EPS is highly fluctuating or facing downtrend continuously, it means the stock is losing the growth potential. Now let us try to understand how the earning per share ratio is calculated. The formula for calculating earning per share ratio (EPS) is profit after tax divided by number of outstanding equity shares. This shows how much profit is earned per share. For example, profit after tax and preference dividend of the company is rupees 500 and the number of equity shares, outstanding equity share is 1000. Then EPS is equal to 500 divided by 1000 shares, that is 500 rupees profit after tax divided by number of outstanding equity shares 1000 is equal to 0.50. It means earning per share available for each and every share is 50 paise for the equity shares.